Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite, we have Chris Engelbert as well as Jamie Engelbert. They're both with Baron Wealth Management. We're going to break this segment into 3 different parts as our monthly registered investment advisor hit as we do each month with Chris. For the first part, we're going to focus on clients and how they can work with their advisor better. We'll look at RIA business as a family business, and of course, we'll run through the 5 key charts as we do. Chris and Jamie, thank you so much for joining us at MarketSite. Now, Chris, we usually talk about how advisors can work hard for their clients. What can clients do to work better with their advisors?
Yeah, Jill, obviously Jamie's an integral part of our service team, and what clients need to understand right up front is really who does what at an RIA firm. So obviously as an advisor, I'm talking to them about investing their assets, et cetera, asset allocation, from that standpoint. But really what they need to understand is that if they need a check or they're depositing money or they're opening an account, that's really part of the service team, and it's very integral and it's very necessary, obviously, at our firm.
All right, so Jamie, what should new clients expect when they come on board?
So what we do is we aim for the client experience to be the same across the board, whether you're opening a $50,000 account or a $5 million account, the experience should be the same. So we typically do an initial meeting where we're gauging the client's needs, coming up with a strategy for them. We do a formal proposal. Then we do a follow-up meeting, explain the proposal. If they decide to move forward, then we go ahead, with documents and setting up the account and that sort of thing.
All right, so Chris, what happens now when you're an existing client? How can you best work with your advisor?
Well, what ends up happening is the service team then follows and monitors up the account. So, for example, right now we're in the middle of RMD, or required minimum distribution season, for anybody over the age of 70 and a half. So Jamie works closely with myself. We go through the accounts, who needs to take their RMDs, when do we need to schedule them to have them come in, et cetera. When I say it's kind of like a doctor's office, it is, because what ends up happening is we know what the clients are going through, and then we talk to each other about when do we need to see these clients come back in, what do we need to do with them, especially if they're having something unusual happening in their life, for example, buying a second home, or unfortunately having somebody going into a nursing home.
Well, it's really interesting that you paralleled it to going into a doctor's office, because I don't think enough people pay attention to their finances when your financial health is so key, particularly if you're paying an advisor. You may as well maximize everything that they have to offer. It's almost like having health insurance. Go for your physical once a year. Why wouldn't you do that? Now, Jamie, this is the most interesting question that I have. I'm going to be totally upfront about this one. What is it like working with Chris and living with Chris every single day?
It's definitely not as challenging as you might think it is, working with your spouse. I think what Chris and I do very well is we keep business business and home home. There's definitely a line drawn there. When we're at work, it's 100% professional, and we're doing our work. Chris handles all the investments, I handle all the client service, and we stay in our lanes. Probably the most key part of it is communication.
Right.
Just talking back and forth, making sure everything's taken care of for clients, meetings, that sort of thing. But communication's the key for us.
It's really interesting because you work together as a family. I would imagine that your clients, you consider them family as well.
Yeah, what's interesting is I've been doing this a long time, and we would start out, with the parents, and now we're getting the children, the adult children, and we're getting the grandchildren. And what they really like is the fact that, obviously we're a family and they're dealing with their family. So there's a lot of connection back and forth with them. They feel very invested with us. They ask us questions like how are our kids doing and what's going on, over the holidays and school and things like that. So they understand family businesses. People really like to walk in and talk, so to speak, with the owners, is what they like to do.
And Jamie, let's go back to the pros and the cons, because in my house, I report on financial media, and my other half is a trader, so sometimes it's like, all right, we got to turn this off. How do you manage that?
Well, definitely, while we're at work, like I said, it's 100% business. We don't really talk about, home topics at work or vice versa. We really try and keep things separate. But I think, probably the biggest pro, kind of like Chris mentioned, is that clients can really relate to you, right. And it's almost like you're humanized because they know you're part of a relationship, whereas sometimes they might see other professionals, as kind of like a sterile sort of relationship, right. But I think they are comforted by the fact of knowing that, you know, we're a family and we want their family to be prosperous. So that's probably the biggest part of it.
Take the cameras to your office and really see how it goes down. But no, it's a really interesting perspective. But Chris, let's go and look at the charts. It's been an interesting October, to say the least. This is something that we've been talking about for a good part of 2018. What are your thoughts on the S&P, where we are right now?
Well, one of the things I really want to point out on the S&P 500 is that everybody, I shouldn't say everybody, but I think investors need to really pay attention to the 200-day moving average. The reason being is that many large institutional pension funds watch what side the equity markets are on of the 200-day moving average. Now, if you're managing $1 billion or $2 billion pension fund, it takes a while to make asset reallocation changes. So I think what's very important is that over the year, we've touched the 200-day moving average a few times, went back well above it, and now we are definitely below the 200-day moving average, and it could be a headwind for the equity markets going forward for the next couple of months as large institutional funds start to reallocate assets.
Right. Let's also look at the Nasdaq comp, because that's another one too where we've seen some significant action. And even just to give a little inside baseball to our videos here, the charts you sent over last night, obviously we have to do our prep work. It's very different than what we're looking at right now on Thursday, October 25th, where we might have been down 3% on the comp yesterday. We're sitting here right now and we're up 2.94%. It's pretty choppy out there.
Yeah, a lot of volatility. One of the things that we think investors are going to have to get ready, and I hate to start talking about 2019 already, since 2018 isn't even over yet, but 2019, we could be entering a structurally fair market, a market that has more usual historical volatility, a market that isn't a one-way price discovery up. And I know it sounds a little trite to say, but we're going to have rallies and sell-offs, and that's exactly what's happening.
Right. Well, that's why you have averages.
Right.
It's not normal that a market goes up 350% or whatever it is over 10 years. And I think investors have become used to that, where just because you have an asset doesn't necessarily mean it goes in one direction. But let's look at the Russell 2000. That one is kind of leading the way in terms of underperformance.
Yeah, it was interesting because back in the spring, we obviously run models in our shop, and one of the things that happened was back in June, emerging markets got kicked out, small mid-cap stocks got put in, and they had a really good run up until September, and then it was like literally the door got slammed with a correction of over 15%. So the real question is whether or not we're going to have a Santa Claus rally, if it's going to take shape, what's it going to look like. But maybe the small mid-cap stocks are really an indicator of what's going on in America as far as the economy goes, and if they are an indicator, it might not be good.
Let's move along to crude. I think it was Monday or Tuesday, had a 4.5% move. That's a big move for that complex.
Yeah, and crude, the crude markets could be going the way the S&P 500. They've had a very linear return over the last 2 years, straight up, and now we're seeing more volatility in the crude complex. It looks as though we're going to have some kind of consolidation. We had one a couple of months ago when prices moved higher. I don't know if this run in crude is over just yet, but obviously it looks like it's going to be taking a breather.
All right, and let's wrap it up with the 10-year.
Yeah, the biggest story for the year, the fact that interest rates went up. They peaked in May. They look like they leveled out again, and all of a sudden we come into September, October, and we see rates continue to go up. That's been one of the reasons cited as to why U.S. equity markets are selling off. Again, there may be some technical things going on as far as treasury issuance in the 10-year, but it looks to us like the 10-year may finally take a breather after making another high.
All right. Well, thank you very much for joining us. And I can't believe it. By the time we meet next time, November 29th, it will have been Thanksgiving already. This year just went by so quick. Jamie, thank you for joining us. Chris, as always, thank you for joining me. And thank you. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.